The Gort Show is sponsored by Ellipsis Labs. Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. You may know of Ellipsis Labs by their first product, Phoenix, a fully on-chain order book DEX that's done over $50 billion in unincentivized volume. This is one of the strongest teams I know in crypto. If you're interested in working for a mission-driven company, Ellipsis Labs is hiring engineers who are passionate about crypto and finance to work on Atlas. You can learn more and apply on Ellipsis Labs Twitter, @ellipsis_labs. Don't forget to check out Atlas too, @AtlasXYZ on Twitter.
A ton of open topics. I don't know where you want to go next, but I have like 5 in my notes to hit on.
Go ahead.
One is on the Aave point, JP Morgan. I think that it's a really compelling risk, but I don't know if you've read Clay Christensen's Innovator's Dilemma or seen like a tweet about it, because the whole idea can be a tweet. But basically, like, it is a common pattern that these big companies only care about their big customers whenever they try something new. So like there is an outsized probability that JP Morgan will be like, hey, we're going to have a KYC app, on whatever, say they use a public blockchain, like a KYC app, which kind of lowers our compliance bill, lowers risk for us. And if you want to be on crypto, you can like log in with a special NFT and use JP Morgan app. But we don't care about like degens levering up ETH, staked ETH, because it's just too small relative to our underlying business. So there is that pattern. So I think it's a real risk, but I don't think it's a guarantee. If anything, I would probably give it, 70-30 against JP Morgan forking Aave and trying to compete for what is today a much, much smaller market.
Yeah, like there's definitely like Pump.Fun and JP Morgan aren't really competing. Like, I'm making this more extreme of an example, but like Pump.Fun and JP Morgan aren't really competing. I'm more thinking just, we're nowhere, like, again, going back to my original point, was like, I just don't think we're very near what like the margins look like in crypto. And if a lot of the beliefs about open source and like, protocolization of the financial system are indeed true, then a lot of it is not very extractive. And that's like provides very good user surplus. And those kind of margins evaporate into user surplus. But in terms of being able to capture that, that's where I have some, maybe a little bit more like, okay. So, but I wanted to ask you quickly, about Banana Gun. This is one where I think we probably agree in the sense that, so I think that Banana Gun has a deal with like Titan or something. And that's to me like a real moat. So like that's one thing I was thinking, like with some of these user facing applications, these teams can have deals like off chain, right? We can talk about like whether or not people think that's in the spirit of crypto, but regardless, they can provide some quality of service, and that's a real like definable moat in my opinion. So the Banana Gun one, I don't know, like so I mean, you have a thesis on like what it can make for you, and it's already returned your money. So like that is kind of evidence unto itself. But like that's one, like wallets, Telegram bots, like I'm probably not going to have much in the way of disagreements with you. People will pay to be able to click. I do it all the time, like 0.5 Sol and have it included, even if it's at, an absurd slippage.
Yeah, that's one where I would say like, superpowers of the industry. Like one is customers trading volatile assets are really price inelastic.
Right.
Because if you think somebody's going to move 400% in like a day or an hour, like 1% fee does not matter if it gives you best execution, right? And if it's where your money is. And like some of these things, I mean, this sector has been trading really low for a long time. Like Banana Guns, made 90 million over the past year, and it's trading at about 100 million right now on adjusted market cap. So right now it's like it's the cheapest it's been for a while. But it was trading at 4 times the whole year last year, even as it was growing, right? So 4 times on like instantaneous metric, and again, it's charging pretty high fees, but the customers are happy to pay because every front is charging high fees because every customer is happy to pay. So I think a lot of the value will accrue to the front end in general, right? Like Uniswap's charging 25 basis points on a front end. You could literally just go to another front end or go to CalSwap and get the same trade for cheaper. Coinbase is, when Coinbase IPO'd, everybody was talking about fee compression. Like that was like the analyst, the analyst concern with the name, and fees haven't compressed at all, right? It's been over 5 years now. MetaMask is charging like 80 bips on trades. So it seems like customers don't care and they won't care about this.
Do you think this is kind of, well, I've said this, but I say a lot of stuff. Do you think that this is kind of a refutation of the fat protocol thesis in your mind? I think it is.
Yeah, I think it's definitely a refutation of hard fat protocol thesis where all value will accrue to the protocols. 100%. Like I think if anything, we are appreciating more and more how much it matters to own the customer.
Yep.
And more value will move towards a percentage of value will move towards protocols on both fees and MEV.
Yeah.
So hard refutation of that. Some, we don't have to get into it, but like there might be some leftover value for the protocols.
Yeah, I think that it's interesting because so I would say it's either a hard refutation or it wasn't really the right model to begin with. I mean, in the sense like Uniswap, with the dual equity token is not like a prime example, but something like Uniswap, they're going after the front end now, right? Like they're trying to own the customer, and the idea, I guess, is the protocol. Like you build the protocol, but then you own the customer that hits that protocol, and so that to me is a little bit more of like it kind of grays the area because it's like, okay, and a lot of this depends on like how the token and like the DAO and whatnot is structured. Like, is that the protocol that's capturing the value, or is that the token that's not related to the DAO or the whatever? So I don't know. Like I have some like it seems. I guess and it seems like you tend to agree is like it seems like this is looking a lot like Web 2, to be honest, in terms of capturing the user.
Yeah, it's got. I think that definitely will be the way it looks. What I would say is, Web 2, Web 3, I'm really more focused on the financial system because that's the more extractive part of that's where things are more broken, right? And like financial system, revenues are like well north of 1.5 trillion. And the thing about cutting revenue and cutting costs is that you can actually keep a fair amount of profit. So if you cut revenues by 90%, but you cut costs by 95%, you're keeping like half the profits. Not exactly, because it depends on the margin, but like that's a good heuristic where you're keeping half the profits because you have a lower cost like business line. So we have much lower costs, as we've discussed, like in protocol land, like on public blockchains. So if all we ever do is cut costs by 90% and not 99%, and there's some left over for investors and teams, that's still a pretty good outcome, I think, for the world and for everybody involved. I just think there's been this push to be purist and like cut everything out, or otherwise it's not good. But you don't have to cut every single thing out, right? People will be happy if they're paying, if the remittances are free, but they're still paying, 1% to Aave for borrow lent.
Exactly. It seems like there's a equilibrium we can settle where it's somewhere between, highly extractive and, completely protocolized. And there's some things that I think will be like roughly zero margins, and then there's some things that will have slightly higher. But yeah, I think this industry spent 10 years trying to basically work on an intractable problem with like creating, animal spirits value out of something that just does not extract value. And now we'll realize, no, you got to actually make money if you're going to launch tokens at $10 billion valuations,
Moneyness.
Yeah. Yeah, exactly. Go ahead.
No, one thing that I want to make sure to like repeat here, because it's something I try to repeat all the time, is, one of the reasons why it's so important for like, I want to keep discussing names, why it's so important for us to like talk about names and talk about predicting the future and like what do you need to believe for this to be a good investment, is because at the end of the day, like investors actually have a pretty important social role, which is you allocate resources in like a sector, right? Like if something, L2 founders aren't building L2s because their life mission is to found L2s. They're founding L2s because they think they can make a lot of money that way.
Yeah.
And that's because investors were bidding up the valuations of L2s and infrastructure projects. And, what we've had for the past 7-8 years is narrative cabal driven resource allocation, where whoever prints the narrative prints high valuations, and those high valuations entice founders to come and build those products. But the way capitalism is supposed to work is that the consumers decide, right? Like, you try to predict what consumers will pay for. If you're right, they pay you, you make revenue, you make a good return. If you're wrong, they don't pay you, you lose money. And LPs see who's right and who's wrong and give more money to people who are better at predicting consumer behavior. But the ultimate node there in deciding where resources go is the consumer and what they're willing to spend their hard-earned money on. And that's why I think we'd all be better future land if we were discussing fundamentals, because we'd be trying to entice consumers into paying us for products, as opposed to enticing future narrative cabal influencers into saying that our product is somehow money or valuable or all of these things that only exist within, that exist with no feedback from the outside world.
Yeah. Yeah. That's a good way to put it. Okay. All right. Let's talk a little bit. Maybe talk about Camino. Very popular lending protocol on Solana now, seems to be doing well. FTV is 1.1 billion and the market cap is 155. This has been interesting. We were kind of talking about this earlier. I'm kind of interested to hear. There's kind of low float here, but doing 52 million in revenue. So similar, not a order of magnitude off of Aave at least. What is your kind of thesis on this?
And I will do a bit of a cop out on this one and just go back to the what price has been over the past year. Okay. Because this is one where price was at 200 to 500 for most of the year, and then it had a big run up recently. So if you were doing, and I guess what I'm trying to prove is that things do trade up at good fundamental prices every now and then. This was doing 35 million when it was trading at 250 million about 4 months ago, right? And it had 70% market share on Solana, no credible competitors on the borrow lend side, and you already had this example of Aave, where they had dominant market share for 4 years with the founder building a social media platform. And on Camino, you had Marius, who was just shipping product after product after product and hyper focused on making sure that nobody could come in and compete with him, right? So you had, it's nothing is easy at the moment. It's always hindsight bias, but you have I just want to make the point that you had this thing that was trading at 8 times revenue with a really good team, with a case study of how big it could be. And a lot of people believe in Solana, but they were buying, they're getting different exposures to Solana as opposed to buying the obvious good fundamental investment that was in front of you. Yeah. So a little bit of a cop out not to use the current price, but again,
that's fair.
There's a way to do this if you're patient.
Yeah, you got in at a good price. But let me ask you something too, which I haven't really talked about yet. Camino did one big airdrop, and now they're doing seasons of points. How do you, as institutional investor, how are you gauging incentive programs, and how much does this distort sort of quality of revenue? This is another, I keep kind of going to points that I screech about on Twitter, but this is another, one of these big questions that I don't know how to answer. And as a result, I find a lot of things kind of uninvestable on the grounds that, if you're teasing an airdrop or running a points program or something, it's orders that sometimes orders of magnitude difference in terms of user base, actual daily active users, wallets, fees, right? Whatever it may be. How do you look at this when you're investing, and saying, okay, well, this metric is good versus, well, they're teasing an airdrop for the past 6 months or whatever?
Yeah. So this, by the way, is an extremely good question. And it's what we got burned on when we started, and also what I think every fundamental investor will get burned on when they start, because it's just too ridiculous. When I describe this to my old friends from jobs, they're so every number is fake because of they're giving away. Yeah. So it's so ridiculous. People won't really catch on until they've been in the industry for a while. look, I mean, you have to do, again, it's not an unknown problem in the general sense. Like when you're doing a buyout, you do quality of earnings adjustments because there are all types of things that impact earnings numbers. And what you're trying to tease out is what's called like the true run rate earnings power of the business. And you have to do the same thing here. Most of the time, if like an L1 or a undifferentiated DeFi app has an airdrop coming or is teasing an airdrop, we just discount the whole thing. Yeah. That's our like the burden of proof is on not just discounting the whole thing, basically.
Yes.
If you have more revenue than incentives and the airdrop is done and there's no tease of an airdrop, then I think, again, burden of revenue is just do revenue minus incentives. Like you're making 10 million of revenue, 8 million incentives, use the 2.
Yeah.
Right. With Camino, it's been something we factor into our underwriting as well. But we think they have much more sustainable TVL than we think the majority of the TVL is sustainable, even though there's a big portion obviously that's related to the airdrops. And that's because, again, it's like a proven category, market leader, best cost, lowest cost of capital in the space. So for those reasons, we've given them a lot of credit for their TVL and earnings, and also because they're earning more than they're giving out in incentives by a pretty wide margin. But I think most of the names, like it's a really big problem, and most of the names that we invest in just have no points program at all for the most part. And sometimes that's wrong. Like we were honestly shocked by how much revenue has stayed on Hyperliquid after.
Yeah, I was going to say Hyperliquid is like such a prime example of, and also the way they had, it was very clear they were going to do an airdrop, but they did such a good job. And it got big enough before the airdrop, and they attracted, small and then medium size and then bigger market makers by the end. And it really did have like a positive reflexive effect where, after this airdrop, people still want to trade on Hyperliquid, right? And then it's like it's one of the, shining examples that sort of gives us some hope, right? Like that there's sustainable. And I mean, Perps is like such a great product, especially for this, the mindset of this space. So yeah.
But it's incredible they did it because they're coming off like 10 Perps platforms that hinted an airdrop, gave it, and then just Burj Khalifa like all the way down towards zero. Yeah. So like the fact that they did it in the Perp space after everyone else had kind of failed to run this program well is amazing. I mean, we'll see what they're doing next year in revenue, but like 600 million right now. So I mean, it's impressive, right?
Well, let me hang on one second. I need to plug in my laptop. I'll cut this.
Yeah.
Okay. Can you hear me okay?
Yeah.
Okay. So, but like on that point of Hyperliquid, do you think that the way that they're doing, we were talking about this earlier, do you think the way that they're buying back Hype, weekly, like, is it that seems like a good model in the way that you described earlier, right?
It's a good model because the team believes the token's undervalued and has like high ambitions, right? And people seem to trust the team. So I think it makes sense. Everybody who's invested in the asset has very high trust in Jeff and his ability to spend that capital well.
Yeah.
I think it makes sense in that case, definitely.
Okay. All right, let's talk about Radium.
Yeah, I was going to say just Hyperliquid is also a really good example of what we discussed, which is like auction network economies, right? Like users bring market makers bring users. You can fork it, but it's not easy to recreate that ecosystem dynamic.
Right? No, not at all. The one, if I had to make I don't want to say bear case. I don't want to get the people who in every tweet in Hyperliquid mad at me, but if I had to make one point, it's just Hyperliquid, I do think benefits to some degree. Some people would say a high degree. Some people would say, less so, but to some degree from the regulatory arbitrage, angle where it's not hard to get a VPN and people around the world are trading on Hyperliquid. And, I look at Trump and I see him launching a meme coin and I'm like, yeah, he's probably going to let Robinhood create a perps platform. I mean, you know what I mean? Now, I'm not saying that definitively, but like that's the framework I have. It's like, okay, Hyperliquid's crushed it. Like they've obviously done, about as well as a project has done in crypto to be like, but again, an industry completely changing from a regulatory perspective.
Yeah.
And if Citadel can start trading, like, you know what I mean? They can provide better pricing than some, middle market, market maker in Asia that's, using Hyperliquid. So I don't know. I guess that would be the one kind of bearish case, or just that would change the dynamics, right?
I agree. I mean, look, in general, if somebody can't give you a bear case or like the risk for an investment, they're lying to themselves at that point. Like you have to be, every investment that we have, there's like multiple bear cases and ways that it can go wrong, right? So you pointed one out for Hyperliquid. Another one is like what you need to believe is another good outcome, right? Like it's trading at 15 billion unadjusted, making 600 million of revenue. So like 25 times price to sales. What you need to believe, if you only value the perps exchange, which I think is debatable, is basically they can keep 60% share for a long period of time, while DEX to SEX goes from like DEX to SEX perps volumes go from 8%, which is like all-time high right now, to 24%. So it's pricing like, and I think there's a reason to do that, which is like you really believe in the team and you think that what they achieved was incredible, they're going to achieve something incredible again. But that's kind of what's priced into 15 billion market cap. So if you're buying into that, I think it's totally legitimate, but you have to be willing to look at the risks, like Robinhood allowing perps trading, right?
Yeah. Okay, I wanted to ask you about Radium. Radium is like a fascinating example of they just have basically they were one of the first, like they were in the early DeFi on Solana. Compare that with like Camino, who's sort of supplanted Solend and MarginFi, right? Like Camino has kind of been the newer generation of apps on Solana. Radium has been there since basically the beginning. I remember farming Radium in like a long time ago, and they continue to do a ton of volume. And it's like not, it's one of your investments, but like the front end and the whole thing is like kind of screwy, but they keep crushing it. So I'm kind of like, they make all this money or they have all this volume at the very least, but I mean, it's like sort of, it's interesting. I don't know. So what is your thesis there?
Yeah. And I'd say that's one that right now it's like 1.5 billion. It's been at, 500 to 1.5 billion, like for the whole year. It's making like 200 million revenue. So it's 7.5 times right now on all-time high. It was trading closer to 4 to 5 times like earlier in the year. And the thesis is basically like they do have a little bit of an interesting moat, which is one, they have a sniper ecosystem. So like when pump coins graduate, they go to Radium. Right. There's like 500 snipers ready to buy it up, and that's actually legitimately hard to replicate on another AMM, right? Two, you're talking about like the fees that they take are just tiny compared to both volatility and the fees people are taking on the front ends. So it's a little bit like why would you sub out Radium and take risk with another player when what are you gonna get a BIP out of it? Like you're not really making anything from it. And then three, you have these. It's a weak moat, but it's a real moat, which is like burn token liquidity. Once you launch a meme coin on Radium, you burn your LP shares. Like that's going to be the most liquid place for that meme coin forever, right? So even like with Popcat, all these meme coins, they have burned LP shares on Radium. It's hard for another AMM to take that back end. So it has some what I describe as like medium moats from what I'm telling you. There are some real risks too, and like this goes into our prior conversation. One, everybody knows the pump that fund risk. Like 70% of volumes are pump that fund. Is Pump going to launch an exchange? People talk about that a lot, like on in fundamental circles. We'll see what happens there. My view is it's a lot of risk for Pump to launch an AMM. Like they're making, to your point, $400 million a year. There's a lot of front ends trying to compete, right? Like Pump is in the front end space. A lot of people are going to try to go for their lunch. Are you really going to like try to increase revenue by 20% by competing with Radium on like a separate part of the stack? But it could happen. My view is like 60-40 no, but it definitely could happen, right? Especially if Radium's not like favorable towards them. And then you have like the you have competitors like Meteora who's playing pretty hard to get meme coin share, and then you have meme coin quality of revenue issues, right? So like again, all of this comes back to like there's not black and white answers. It's all nuance. Like was it good buy when it was at 500 and it's buying back half its shares? I think probably. Is it a good buy today? I still lean yes, but like it's getting harder, right? It's all valuation focused. It's all valuation sensitive.
Thanks for listening to The Gort Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Yeah, I think my kind of other side of Radium would be the front end is, to me, at best, somewhat undifferentiated from AMMs in general. And then at worst, it's just not great. It's just like annoying and hard. I mean, yeah, the UX I think could use improvement. Now, I don't know how much front end flow goes through Radium. Like I think Jupiter has a lot now, but I mean, I guess that routes through Radium oftentimes. But if we're talking about owning the customer, right? Like I don't know if Radium is so well positioned for that, especially with Telegram bots and stuff. And then my last thing I would say is I'm not convinced on Pump. I'm not convinced that Pump isn't going to just do something crazy and launch their own single sequencer exchange. Now, I think there's a lot of possible, I think there's like different directions this could go. But there are definite, like I will say this, there are definite things that Pump could do. And I look at it sort of like this, like Pump wants people to launch coins and they want to make money because more people launch coins. There are things that they can do to take less rake out that's not themselves. So that wasn't well articulated, but they can create an ecosystem that's a lot more favorable and the rake isn't 10%. And, I've thought about this, I'm not entirely convinced that they even need a blockchain for what they do. I could definitely see them, and this is going to sound weird, and I don't know how this would be done like on a technical level, but I could definitely see them doing something like scratching using Solana in the background until a coin hits a certain market cap or and then it's liquid tradable on Solana or wherever. But I think there's a lot of things that Pump realizes money's coming out of the ecosystem that they can prevent. And so I don't know. I guess that would be kind of my and then of course, like going back to your point about like quality of revenue of meme coins, I'm probably actually more of the opinion that there's something probably here. Is it going to be Pump? I don't know, but these things, speculative manias. Last cycle we had NFTs, we had DeFi summer. Like these things come and go, right?
I think those are all fair points. What I'd say is, those are all fair points. Like those are all risks that you take with this investment, and what you're getting is like a really high growth, highly profitable like segment of the on-chain economy. But you have to have, so what we do when we underwrite all of these things is we do a fan of outcomes, which like we use 5 cases. You could use like infinite in theory, but we kind of say like, what are the 5 most likely cases here for what this looks like in our underwriting period, right? And sometimes it's 2 to 4 years, sometimes it's shorter or longer depending on the investment. Anything with meme coins, we re-underwrite more often because we have to make sure that 6 months, a year from now, it's still a good investment for us. But basically what we do is we say, all right, there's like a case where Radium keeps 60% share and is able to earn, X amount of money over the next 2 years based on volumes. There's a case where they lose share and meme coin volumes drop. There's a case where Pump That Fund disrupts them, in a material way. And we kind of like get the whole team on. The three of us have different levels of optimism, pessimism, like things that we will focus on, and we give our probabilities independently, right? And we kind of lay out like based on these probabilities, are we getting our cost of capital in the time period? So all of the things that you're saying, we when we bought Radium like 6 months ago, we considered, right? Yeah, as part of the fan of outcomes, and we could debate what the probabilities are, but I think that the interesting thing is like that we're having the debate at all, right? About the like possible future worlds and what they mean for like actual fundamental value today. Yeah,
that makes sense. Okay, what is Houdini?
Houdini is it's actually a great one. I'm happy that we're talking about it. So this is one that it is like the quintessential wish list for like a small cap investor in TradFi. Like it's a router with a compliant privacy option. So you go on the front end, you can send any token, any chain to any token, any chain. That's not the profitable part of the business. That's kind of a loss leader to bring people in. And then you can click a compliant option and it goes through P2P exchanges on the back end for you to break wallets, right? So if you're a fund and you want to use a fresh wallet for something, you can use Houdini. If you're like a meme trader and you just want to have a fresh wallet that can't be linked to your entire like on-chain personality, you can use Houdini break wallets, and you're paying like 40 basis points. So it's not nothing, but it's a pretty good option for privacy, right?
Yeah.
Privacy is compliant privacy. Again, it's an interesting space because most of the builders have gone one of two ways. Like either they've gone full cypherpunk, like it needs to be fully private. North Korea can use it. I don't care. I don't want to have any records for the feds to like track this. That's not what Houdini is doing at all. And that's been like one way of doing it. But most people don't want to use those platforms to not get tagged as like a potential part of the privacy set there. The other approach has been like ZK solve privacy at the infra level, like 5 years out, doesn't matter. We're going to solve this and bake it into the protocol. And those just don't have products, right? Like they don't have usable products. So Houdini is now going on 2 years, 2 years now of just being able to clip fees in the middle of these two like sides of the business. We invested when it was like 700K market cap, 7.5 million market cap, 700K of revenue. It's grown every single month since we invested because it just has really high retention. The team is really good at growing this slowly. It's now at 40 million market cap, earning 7.5 million of revenue. And like it continues to grow month over month. Again, because of high retention, good team. Like it's kind of like a SaaS business.
And are they buying back tokens or is it, dividends? Like how are they doing it?
They're doing buyback and distribute, which we can debate as well. Which is like if you stake your tokens, they buy back and distribute to stakers. So we're just kind of buying. We're constantly, by staking, we've been constantly buying Houdini token for 2 years.
Got it. And so they give you more tokens.
They give you more tokens. So we become more ownership over every month, basically.
Got it. Yeah. How do you feel as a fund about? Did you guys stake those tokens?
Yeah, we stake. We stake. We have to manage our stake because of liquidity requirements. So like it's really hard when someone has like a 4-year lock because we just, in theory, if everybody leaves our fund, we won't be around for 4 years. So you can't have an asset liability mismatch where the tokens are staked for longer than you can promise, your LP's redemption terms. Yeah. But this is like a quarter lock, and they actually just moved it to 30 days yesterday. So like we can do that, and we just have to manage our like asset liability match in-house basically. Yeah. But yeah, this is like one that I like to bring up because it just points out like one, we've made our full initial investment on value of tokens distributed on this one, plus a multiple. It's not sexy or in the narrative at all. It's actually the opposite. Like you're using P2P exchanges to, break wallets. Like it's not, nobody would ever find that interesting enough to go to do a podcast about at the like infra level or tech level. But it's a product that people are willing to pay for. And it's a team that just like has a good nose for following high retention, profitable customers.
How do they do the, like, how does it break wallets? So when you say like compliant, what does that mean? Like, you cut KYC and then it does it, or what?
No, so it's compliant because they know the two wallets on the back end. So if the federal government ever said like, hey, North Korea, use this, they'd be like, well, here are the two wallets. Like,
got it. Okay, so it's like a private intermediary almost.
It's a little bit like using Coinbase, but just set up the privacy element.
Got it. Okay, yeah, that's interesting. That seems like a real business, I suppose. Okay. Do you want to talk more about the tokens that you listed, or do you want me to ask you a few like last questions?
Let's go with let's see. Let's go with last questions. I'll bring in tokens as needed.
Okay. What do you kind of refuse to invest in? This is interesting. Like, let's take the other side of this. Like, what do you look at and say absolutely not? And what are the reasons for that? It could be, verticals or like chains or whatever.
Yeah. We've covered a few of them. One is if the team is fully anon where they won't get on camera with us, we refuse that right flat out.
Yeah.
We had a bad experience doing that. Like we came in kind of ideologically in favor of like, hey, if it has the cash flows, we can track the incentives, it's fine. And then a lot of like more mature investors in the space told us to not do that. They're like, look, it's not going to work out well. And we had one investment where we got our full money out, but like, we bought the thing at 40 million. It's making $100 million today. I won't name the company, but they just took the entire company out of the token. Right.
Yeah.
And it's like,
that's what I mean.
Yeah. It can happen. Right. And we think the probability is just substantially higher if somebody's a proper anon, where they're not known to us and community members, and like, we're not seeing their face once a week to talk about business. So hard rule on that. Hard rule on the token equity side. Like if you have an equity program that's accruing value, we're not touching it because we just know we will get burned by doing that. And then I'd say we have a pretty hard rule on obviously mercenary founders, which is probably the majority of the founders in the space, like people who clearly want to make money quick and we think are likely to sell their token if it trades up to like $1.5 billion, just to throw out a number, because our whole investment approach is to like bet on the industry, bet on like fundamentals growing and a team actually being able to have like, at the end of the day, our returns will come from like doing good investments overall, but a few teams that actually went through with it and built like $20 billion companies over a decade will be a lot of the returns. And if somebody doesn't even have the intention of doing that up front, we're not interested, right? Like we don't want to be the long-term holder that gets dumped on by the founder. It's just obviously not a good place to be. So we try to suss that out through like, just through kind of common sense and judgment, and people make it pretty obvious when they're in it for like the very short term. There's probably more things, but those are the ones that come to mind.
Yeah. What are your thoughts on, we've obviously discussed this, but if you're looking at tokenomics for a project, like what do you want to see? And again, we've kind of discuss this, but I want to know just like if you had an overview, like, or is there anything that stands out? They're like, that is a terrible idea. Lockups, vesting, airdrops, like how much percentages, any thoughts, like just in general, and maybe I'll pry more.
Yeah. Before, we discussed a few, which is like, be careful with airdrops, be careful with equity. We want to make sure that the distribution mechanism aligns with our view of the team, like we discussed a few times, or like our current view of the team. And then we discussed the lockups, like really long lockups don't work for founders. I think the main thing we watch out for is just gamification. Like we want the token to not be a game, and we try to like help our teams with a lot of stuff. in theory, I don't know how much, I like to think they were helpful, but maybe one of the most helpful things we could do is just remind them constantly to avoid games of tokens, because every founder is pushed so hard to gamify the token because of the history of the ecosystem. So for us, like the less gamified, the better. If it's just like, distributions, buybacks, simple TradFi looking mechanism, that's ideal. If it's got like docs for the token, that's a red flag for us.
Yeah. Okay. On that note, you only invest in liquid tokens. Is that right?
That's right. We do we have a tiny pocket for like pre-TGE, but it has to be looking to TGE, within 6 to 12 months.
Would you say that there is, I don't know if tension is the right word, or would you consider VCs generally your adversaries? And I don't necessarily mean that in such like a negative way. Well, I mean in terms of the incentives, right? Like, just this past week, we've seen some projects and the history of this industry, right? Like where a lot of my cynicism is derived. It seems to me that liquid funds would at times have very different incentives, assuming that, even both sides acting in good faith, theoretically, right? Like we can even debate what that means. But I am curious, like as a liquid fund, how you see VCs and like how, that affects your investment strategy when certain VCs or like their tendencies are involved.
We can be friends, right? Like there's no need for there to be a tension. Like the typical path is you fund a project, the project builds a good business, they build some fundamentals or like a decent go forward look at fundamentals, and then you IPO or like launch a token at a reasonable price, and we buy. Like we're happy to buy things at 200 million, right? Like we don't have to buy things at your VC entry price if they built up a good business and like reduce the risk of failure, right? So like there's a trajectory that's fair for everyone that works. I think the reason your question is funny is because obviously VCs try to launch tokens at unreasonable prices, and I don't know, or they as an aggregate, that's not true for all VCs, but like as an aggregate, they've tried to launch like tokens that are worth $100 million at $5 billion. Right. Or worse, that's like an average case. And that is, I don't know if it's adversarial, but like it doesn't it's annoying because we'd be happy to buy these things if you launch at a fair price, but you launch at a price where it's only going to be like narrative driven retail that buys, and the chart's going to be down 90% in 2 years. And like maybe we'll buy it then, but maybe the team will just be like burnt out from having lived through a 90% down chart for 2 years. Yeah. Right. So I think the high token launches are destructive. But again, and then I think that the narrative game is destructive too, because what we need, and like the reason that we push for it is like, we just need businesses that can grow fundamentals over a long time because we're holding these things. And if you're just trying to create a narrative exit and get the team to spend their time gamifying tokens or gamifying narrative and like trying to get retail buyers to buy in, then you're just not spending our limited resources building the businesses that we want to buy. Like we have more capital to deploy. We want to deploy more. There's just not enough investable tokens at reasonable valuations. So there's a little bit of tension there that I think we've all seen. I think for the most part, the liquid funds are not, at one point maybe they did, but they're not playing the game, which is why these tokens go down 90%. Like we are the plug. We are the only buyer at scale.
Yeah, exactly.
So I think there's been like some market discipline enforced. But somebody like John Charbonneau posted, he was like, don't tell VCs to not buy like infrastructure projects. We are playing the game the market is giving us, right? I consider him a very smart player. But I think he's actually right. Like the burden of market discipline falls to liquid funds. So I get more annoyed when a liquid fund starts buying vaporware. I'm like, you're the one who's supposed to pass on this and send it down 90 if it's not worth it, right? Not the VC fund. Like if you're buying it, they're just following their incentive, right? But we have an incentive to not play that game.
The history of crypto VC has been like much, much easier than liquid investing. Would you generally agree with that?
I don't. So during 2021, yes. right? Because they had a proper exit period. I think now DPIs are pretty low. And like, so TVPI, DPI, TVPI is like what your book is marked at. DPI is the amount of money that you've actually been able to return to investors. And, you know, we have I'd say it's harder for liquid funds to generate TVPI, which is like paper marks, but it's much harder to generate DPI because all our stuff is actually properly liquid. So DPIs, like, I think are still relatively close to zero for a lot of funds that were raised in the last 4 years. So it's not that even though they ship these tokens at these high valuations and have high paper marks, it's actually not that there hasn't been that buyer to buy on the other side in size. And the game hasn't really been working for I'd say for the median player. Yeah. You know, there's obviously great results, but the great results have been for what I consider to be like great firms, right? That are kind of playing the game very well.
Yeah, that makes sense. Do you, okay. Do you think that, what do you think is like the 5-year prognosis for kind of like infra VCs on that note? Like, go ahead.
I don't know it well enough. Like, there are some people who are really sharp and understand like N sub 50 topics. You know, like we mentioned John Charbonneau, for example. Somebody like that should be investing in infrastructure and making money doing it, right? Like in a world with proper capital allocation. But I think that across the board, valuations have to come down for that to work. And there's some element of, there's much more attrition in liquid funds. So like when we started trying to open the fund, people would be like, you know, there's all these great funds. Why would we give you money? Like Alameda and Three Arrows, and like they'd list all these names that are basically none of them exist anymore.
Yeah.
So if you kind of are reckless as a liquid fund, you get booted out fast, and that becomes a market mechanism that like reflects, you know, it goes into the market quickly. I think on VCs, the attrition, you know, with the 5 to 10 year life of the fund is just much, much lower. And you can show these high TVPI marks and some LPs will believe you and like give you more capital. So it's going to take longer to discipline that market.
Hey, this is Will with Blockspace Media. And I don't know if you heard, but we just announced the second edition of our conference series, Op Next, now to be held at the MicroStrategy HQ in Tysons, Virginia.
That's right. After the success of our first scaling conference at Fidelity last fall, we're doing it again this spring, April 11th and 12th at the MicroStrategy HQ. I'm really excited for the programming. We have various stakeholders, industry, developers, and Bitcoin miners present.
So join us in April for open, neutral, and honest conversation about the leading proposals and technical solutions that will scale Bitcoin to the next billion users. No booths, no tokens, no shills, just Bitcoin and honest conversation.
You can find tickets and more information at opnext.dev or click below in the show notes.
Yeah, it seems, well, I guess it's maybe why I have, I don't know, greater respect, but I do think liquid funds are like ostensibly in the trenches as well. I mean, that's not the right way to say it, and I know that there's a lot of OTC stuff. Like, this isn't lost upon me, but it seems like you guys at least have to, I mean, especially your fund, right? Like, and to be honest, I don't bring like some randos on here to show their bags, right? Like, obviously, I think that if you're going to come on and show your bags, I think like I felt that you were, you have good fundamentals, and maybe you have a good thesis on fundamentals. Maybe I don't necessarily agree with this, but this is just like my own perspective. But yeah, I do think that it seems, I mean, I just have some like obvious reservations about, so many of the VCs in the space, and it's really, really hard to rectify that. I think it does seem like the market's correcting to some extent, but even going forward, it's just, if you can, create a token at, virtually zero marginal cost and get into the seed round, like, you will make money, right? And so, like, I guess that has been historically what the case is. And, I was telling you this the other day when we were talking, I won't name a name, but I was looking at a well-known VC. I was looking at their last fund, and I tried to map the tokens that they had invested in. I think I more or less, figured out when they had invested. And they had like, let's call it like a dozen or 15 tokens that they invested in. And not a single one of those tokens is up in dollar terms over 4 years, right? Like they all went up to one all-time high, and now they're all down. And we're not talking about against Bitcoin. We're talking about against US dollars. And like, to me, I look at this and I'm like, this is a fundamental problem. And I know that, the past couple of years of Twitter, maybe I helped to some extent, like, shitting on this stuff, but there's still a huge gap, right? And like, there's something wrong with an industry if you can't sustain any token over the course of 4 years, right? Like, something's wrong. And I know like valuations get pumped and stuff, but I do feel like strongly about this, right?
Yeah, no surprise. I think that comes back to the fundamentals point, which is like, if you are narrative trading and meme trading are the same thing, right? It's just like, what story do you tell to get people to buy things? If anything, I think meme trading is more honest because like everybody knows the game they're playing. But if you are doing meme/narrative trading, you're playing a zero-sum game. Like, it pays to be early, buy early, sell early.
Right.
It's not smart to buy late, sell late, because all that's happening is people are throwing their money into a pile. Some people are taking it and walking away. Some people are losing it, right? But no money is created. And that's why every meme/narrative chart goes up and then goes down, and then converges towards zero over time.
Yeah.
The fundamental investment, your like quote exit liquidity is like happy paying customers, right? People who like think it's worth buying your product. So Buffett doesn't care if anybody buys Coca-Cola from him. He doesn't need to shill it because the customers are giving him money, right? And like the same is true for all of his investments that have just only gone up over 40 years because customers are paying, and like there's net value created. But in the absence of the customer, every chart will go down over enough time, and anybody who bought late will lose money.
I think it's actually kind of funny. Sometimes people outside of crypto who just observe what goes on have a much cleaner intuition. I saw this recently. Nikita Bayer, the tech guy. So he said something that is like, it's so straightforward. He was like talking about, watching all these celebrity and like burned out Silicon Valley guys launch these meme coins, right? And he was like, if you're buying a celebrity coin, it should be because you think there's future, growth or some type of value created for owning that coin, not just being early in that coin. And it's like, my only point in saying this is like, he obviously is, I'm sure he understands crypto and is like, adjacent in many ways, right? But he's not like in the weeds building, DeFi protocols. And it's so intuitive to people outside of this industry. It's kind of funny. Like, you see they get it. It's like, whoa, it should be based on like some, future expected value or clout or something. It shouldn't just be that you heard from your Cabal chat that you got into some, token early. And like, it's funny because that actually maps really well to a lot of VC, like the vast majority of VCs, right?
And a lot of liquid funds and liquid traders too, And like, every time the market goes up enough, everybody gets drunk essentially for like a period of time, right? So like, the AI agents, like nobody would have thought that if Bitcoin had not just doubled in like 2 months, but then your brain just becomes mush for a little while. So like somebody was asking me, we wrote a lot in December, and somebody was asking me why. I was like, I just need to not do my job for a month. Like, I just need to look away from the screen for a month, because every time I look, I can feel my brain just becoming mashed potatoes in my head. So it's almost like just managing these emotions becomes extremely difficult when you're inside of the industry. And like, I read that a lot when I was like reading all these like value investors or fundamental investors from the past. And I was always like, yeah, that's like a folksy thing to say. And it's like, it sounds clever, but there's no way that's the real hardest thing, but it definitely is. Right.
Yeah. And I think also when there are some of these kind of organic narratives that crop up, like meme coins first, and then the AI agents and the celeb coins, like all of a sudden the VCs who are investing, ostensibly in infra or, value driven projects, they all of a sudden feel compelled to like develop a thesis around it, and we saw this 6 months ago. Well, 12 months ago, we had all these VCs like debating like, are meme coins good for the industry? And, talking about how it's also this like, insider cabal thing, and all that can be true. And then like the president comes and launches a meme coin, and it's like, oh, like, thanks. Like that was a very valuable conversation you had there. Like literally nobody cares what you thought as to whether or not meme coins are of value when the president walks out and he yeets one. Like, thanks for breaking that down for us,
Thanks for breaking that down for us. It's hard, man. It's also the incentive, right? Like if people have LPs, and depending on your LP composition, like you might be getting, luckily my co-founder is super tight about who he lets in, and like his whole focus is on quote good LPs according to him, right? But like if your LPs are calling you about missing some meme coin or AI agent narrative, and you have the natural like tendency of brain becoming mush, it gets, and like somebody, X, Y, Z outperformed you in this year and like are posting about it, it becomes a very tough incentive to deal with as well.
I actually had a question on that. We're running like really long, so we'll just make this 2 episodes probably. But I had a question on LPs. Like I've talked to a lot of VCs and some, liquid guys too. I mean, I don't know like a lot of people in the space, but I do talk to some people, and I've never actually really asked about this. Like, what is kind of your expectation of LPs in terms of like them contacting you? Like, for example, the sponsor of my podcast, like I'm really good friends with the kid, Ellipse, like that's why he sponsors me, right? And he does not care what I say, right? And like that to me is so valuable in the sense that like they have a business and he's totally cool with me saying whatever because I'm not gonna, shit on his company or whatever. I'm curious from the investment perspective, like if these people call you, I'd be like, dude, you you're not the investor, but I'm sure that is not exactly how it works.
No, it's not. It's not at all how it works. It's like the same way that when you peel like the onion on a lot of what founders are doing, it's like because of investors and what investors are asking for or like directing. It's the same thing happens one back on the LP level, right? So like, but Buffett obviously is like the ideal for a lot of stuff. He has this holding company because it's the ideal LP situation where he just has permanent capital. Yeah. You can sell the Berkshire stock, but you can't take money from him. So he can just do whatever he wants, thinking long term without worrying about LPs, right? And like, private equity has done really well for a long period of time. And I think a big part of it is you're locked up for 5 years, and you're locked up for 5 years, and these guys have to make returns on cash flow. Like they're kind of locked into a good strategy to some extent, right? If your LPs are frenetic and calling you once a month and you have pretty loose redemption terms, like it's going to put a lot of pressure on you, and not just emotional pressure. Like they can withdraw, right? And like many LPs can withdraw at once if you're a liquid fund. So if they're the type of people, like the liquid fund, by definition is liquid, right? To some extent for LPs as well. If you are with people who are going to really be focused on charts and are focused on and have a lot of money with you and are focused on like narratives, that's going to drive you to invest that way as well. No matter what, you have to treat them, with respect. Like at the end of the day, you work for them, right? Like you actually work for them because you're managing their money. So, but there are people who are, people who really get the game and like understand that the best results come from trusting somebody and letting them play out a thesis over a long period of time. And you can kind of see who it is up front too. So again, I'd say we have really good LPs. Most of them aren't in the industry. They get periodic updates from us. And if they ask the question, it's like a good faith question. Like, hey, what happened to FTX? What does it mean for us? It's not like, hey, you hear about AI agents. Should you have been investing in those? Like really not in our thesis. And I'd say by and large, all of our LPs know it's not in our thesis, and they're not going to ask us those questions. And that kind of gives us more freedom to kind of do what we, invest the way that we think is the right way to invest. But it really matters. I think it to some extent, it all goes back to that, right? Like people launching people launching tokens at high valuations, to some extent, that's because they got to show TVPI, and people selling, it's because they have to show DPI, right? And like a lot of it goes back to the LP incentive.
Yeah. Yeah. And then like the incentive to show high, ostensibly mark to market or whatever, and then raise another fund. It's like, it's all very screwy. All right. I had one last question, at least from my side. Do you mark your book against, I think you said you hold some Bitcoin too in the fund, or no, but do you mark?
Yeah.
You do hold Bitcoin.
We do hold some. Yeah. We hold it as unallocated capital.
Yeah. So I'm curious, like, do you mark your book to Bitcoin first and foremost? And what is your kind of like expectation in terms of returns? And this now comes back, like, I guess, kind of full circle to my, like, the original, context of this conversation. And I'll just tell you, I'm not investing capital the way you are, but like a lot of times, when I look at this stuff, the other side is Bitcoin. And so for me, it's very hard to justify investing, like a return profile above Bitcoin. And for me, it's much higher in the sense that, like, I look at Bitcoin, I don't know, I don't have some like, moon math or anything, but over 3 or 4 years, I wouldn't be astonished if Bitcoin went to 750,000. You know what I mean? Like that would be on my higher end, but it wouldn't completely astonish me. So like my kind of hurdle rate, that's not exactly the right word, but like my kind of hurdle rate is like very high in terms of allocating away. So, and I think that a lot of people this cycle have generally taken that approach. Like, you hear the barbell thing. Originally it was like Bitcoin Soul, and now it's like Bitcoin and pump.fund shitters at $5 million or $5,000 market cap, right? Like, it's like, I want 100x or I want to hold Bitcoin. And I'm curious, like, where you, like, first of all, you're marking to Bitcoin, and then to your LPs now, kind of bringing in the last question, where do you, like, how do you talk to them about this? Like, we want to outperform Bitcoin by X amount or whatever.
No. Our cost of capital is, like I said, we think 50% is a fair cost of capital for investing in the sector.
Yeah.
We're a different so we hold a little bit of Bitcoin as unallocated capital. It's a little bit of it can be uncomfortable. There's a reason why we do it, which is it's more correlated to our assets than USD. But if you're investing in us, one, you expect the Bitcoin proportion to be low, right?
Right.
Because you can get Bitcoin for no fees, right? Essentially. And two, you're getting a different factor exposure.
Right.
So our fund is a way to get exposure to like the internet finance thesis. As internet finance takes share over traditional finance, our companies should do well if we do our jobs right. And that's not the same thesis as Bitcoin as global reserve asset, which is the reason people buy it. So if you want to have that exposure, you get Bitcoin, no fees. If you want to have internet finance exposure, I definitely can't advertise our fund. We're not an advertisement in any way. But when people invest in us, they invest in us for that reason. So it's a separate factor. It's the same way you invest in like a healthcare fund, a pharma services fund for some pharma services exposure.
Well, actually, I just thought of one other thing. You come from private equity. What does the lending space look like right now? And do you think that, like, I mean, like, Three Arrows type uncollateralized lending, not like on-chain stuff. What does that look like for liquid funds? I assume you guys don't use
any leverage.
But I'm curious, coming from private equity, right? Like, returns are juiced as a function of being able to borrow 40-50% on, when you're going to make a buyout. When do you think this industry moves in that direction?
Yeah, so it's a good question. One, I would say it's really dangerous to do that with liquid tokens, right? Private equity is, the stability on these companies is not even one order of magnitude. It's like multiple orders of magnitude more stable. Yeah. But like these tire companies, they've been growing at 5% every year for 30 years. And like a bad year is like you grew at 2%, like maybe -1. And you're also getting, because of that, you're getting company by company leverage, which is really important. Right. So if like you have 15 companies and one goes bust, the other 14 are fine, even if that's underwater. And you're getting really good terms on the leverage.
Right.
Like if you pay interest every year, it doesn't matter if your like net asset value is under the debt value, you paid your interest, so you're fine for that year. And if you miss on interest, there's like 30 clauses that you have to kind of remedy the situation before you get into a situation where you're handing back the keys to the bank.
Yeah.
So it's like completely day and night different to levering up your ETH with, levering up your ETH on Aave.
Right.
Dip below the price for a second, it's gone. And it's because of all, legal recourse and fund reputation and all of these things. So I think we're very far from that being like a good strategy. I think leverage for the most part in liquid tokens is, maybe the worst strategy. Like we've been discussing a lot of bad things, but that's probably the worst one of all of them. But I do think that these players like Morpho and Euler are opening the design space for protocols to do some corporate finance on chain. So that's really exciting. It's really exciting. Like you can put tokens up, borrow against your tokens to build it to work on a project. You got to be careful with those things. You want to be like 20%,
LTV.
And you want to have cash flows, and you want to have terms where if you pay your interest, you're fine. And you want to bake all these things in, but the tech is getting to a point where we can start to experiment with that a little bit. And like every time you experiment with corporate finance in a space like this, like there'll be a lot of blowups. People make bad choices. But I think it is something worth experimenting with, because if we're going to be competitive with TradFi at all, we have to have some muscle memory, like some good practices around lending, like interesting lending on chain. Because right now the paradigm is like, again, post ETH, borrow USDC. That's not interesting, right? It's led to some cool things, but for the most part, it's not nearly as interesting as what we can actually do with the design space.
Yeah, like lending to actually put capital to its highest use, not lending to buy more tokens and then deposit those and now buy more tokens.
Exactly. Yeah, lending to, again, in the future company like Metaplex is making 200 mil, they can probably borrow 100 mil and pay interest payments on that and use it to build out some new project, right?
Yeah.
I don't know if that's the exact case, but it works.
Yeah. Well, is there anything we didn't touch on? I feel like we covered a lot. You got anything else you want to talk about?
No, this is great.
Yeah. All right. Well, awesome. Thanks so much for coming on. I appreciate it. It was, I think this stuff's interesting to me. That's what I will say. It's fascinating. Obviously, I'm not as experienced in like this type of stuff, so it's always interesting to talk to people. And I think this was like very comprehensive. I think we got a good overview of your kind of thesis.
You have like an open mind, and you push back on the things that we worry about or we push back on internally. So I think this is great.
Awesome. Well, thanks so much for coming on.
Awesome. Thanks for it.